Welcome back to Understanding Whole Farm Revenue Protection. In this video, we will discuss what the microfarm program is and introduce the 5-step process for getting your operation covered by whole farm revenue protection. Now that we've discussed what whole farm revenue protection is and who it's designed for, let's talk about some of the important deadlines producers must meet. Missing one of these deadlines can affect eligibility, delay coverage, or even result in the loss of insurance benefits. The first deadlines producers encounter are the sales closing date, cancellation date, and termination date. These dates vary depending on whether the operation files taxes on a calendar year, an early fiscal year, or a late fiscal year, and they may also vary slightly by county. The sales closing date is especially important because it is the final opportunity to purchase or modify a policy for the upcoming insurance year. Later in the season, producers must submit a revised farm operation report, typically due by July 15th. This report allows producers to update any significant changes to their farming operation after planting has occurred. And finally, there is a contract change date, usually August 31st, which is the deadline by which USDA announces policy changes. These changes will only apply to the following insurance year, not affecting any current coverage. These dates are critical because WFRP relies heavily on timely reporting. Producers should work closely with their crop insurance agent throughout the year to ensure every deadline is met. While WFRP works well for many operations, the USDA recognized that smaller farms often faced unique challenges when trying to participate. To address this, the Risk Management Agency introduced the microfarm policy. Microfarm follows the same general philosophy as WFRP, to protect the overall revenue of the farming operation. However, it was specifically designed to reduce the paperwork and administrative burden placed on smaller producers. Traditional WFRP requires fairly detailed documentation, including inventory adjustments and extensive revenue verification. Microfarm simplifies much of that process by using a streamlined approach that makes participation much more practical for smaller operations. The goal was to make whole farm revenue insurance accessible to producers who may not have dedicated accountants or sophisticated record-keeping systems, but still face substantial financial risk. In many ways, microfarm serves as an entry point into whole farm revenue protection for smaller agriculture businesses. For operations that generate relatively modest revenues, but often rely heavily on direct marketing and diversified production, microfarm is a great option for revenue coverage. Examples include small livestock producers, beginning farmers, farmers market vendors, community-supported agriculture operations, and farms selling directly to consumers. Many of these businesses produce several different commodities throughout the season, making traditional single crop insurance difficult to use. For example, imagine a producer is in the second year of a diversified beef, sheep, and pasture-raised chicken operation. They sell calves and lambs in the fall, market freezer beef directly to local consumers, and sell eggs throughout the year. Purchasing separate policies for each livestock enterprise would be impractical and potentially impossible. And with standard WFRP coverage, they do not have the historic documentation to apply for coverage. Microfarm allows the producer to ensure the overall revenue generated by the operation, even on the smaller scale that this farm produces. This makes the program especially valuable for beginning producers who rely on multiple livestock enterprises to diversify their income and manage risk. Although WFRP and microfarm share many similarities, there are several important differences producers should understand. The first difference is the maximum amount of approved revenue each program allows. Whole farm revenue protection can insure operations with up to $17 million in approved revenue, making it suitable for large commercial farms. Microfarm, by comparison, is intended for much smaller operations and currently allows up to $350,000 in approved revenue. The programs also differ slightly in available coverage levels. WFRP offers coverage ranging from 50 to 90%, while Microfarm currently offers coverage from 50 to 85%. Finally, the intended users are somewhat different. Traditional WFRP generally serves commercial farms, diversified livestock operations, and larger specialty crop producers. Microfarm focuses primarily on beginning farmers, local food producers, direct market operations, and smaller diversified farms. Each program was developed to meet the needs of a different segment of American agriculture. Selecting the appropriate program depends largely on the size and structure of your farming operation. Now, let's dive into how whole farm revenue protection actually works. The first step is determining the farm's approved revenue. This process is handled by an approved insurance provider, often called an AIP. These are private insurance companies that sell and service federal crop insurance policies on behalf of the USDA Risk Management Agency. Examples include companies such as ProAg and Farmers Mutual Hail, often known as FMH. The link shown below will take you to a list of the approved insurance providers in your area. The approved revenue is decided by comparing expected revenue and historic revenue. Whichever value of the two is the lowest becomes approved revenue. Once this has been established, the producer chooses their coverage level. That coverage level determines how much of the farm's revenue will ultimately be protected during the insurance year. After approved revenue and the coverage level have been established, the next step is calculating the farm's insurance guarantee. The insurance guarantee represents the amount of revenue protected under the policy and is calculated by multiplying approved revenue by the selected coverage level. At the end of the insurance year, the producer's actual allowable revenue, known as revenue to count, will be compared against that guarantee. If the farm's revenue falls below the guarantee because of a covered cause of loss, the producer may qualify for an indemnity payment. Remember that WFRP is based on production, not end-of-year revenue. If a commodity has been produced during the insurance year, this will be reflected within the year of production, not at time of sale.